And I do have some notes on notes receivable. This is just when I really cover it, when I've covered it in depth in other iterations of the course, when I've put more emphasis on this. So in some ways, I believe it's a little bit of overkill. I want to talk about them just more generally and how we value and excuse me, and recognize them. So notes receivable. Remember that we have a distinction between notes receivable and accounts receivable. These are formal contracts with specified maturity dates. Sometimes explicit interest, explicit or stated interest. So they say you have to pay semi-annual interest payments. Whereas accounts receivable are those informal agreements we have with certain customers or non-customers in the case of non-trade receivables. That is a very different thing than what we do with notes receivable, which is a very concrete legal financial contract with interest usually at play. And we can exchange notes for money. So we could borrow through a note. And we can also exchange notes for goods and services. And of course, we have two parties to the note. We have the person who's effectively the borrower, the person who, if they are in a cash exchange, they're receiving the cash. If they're in a goods services exchange, they're receiving the goods and services, and they're saying, okay, I'll pay you later by the terms of this note. And we have the lender who is either providing the goods and services and telling the person, hey, well, then pay me in the future, or they're providing the cash and they're saying, hey, pay me in the future. And it's good to look at the transactions for these things side by side so that you can start linking things together. Like the borrower's note payable is the lender's note receivable. The borrower would record some amount of interest expense over the note. The lender would record some amount of interest revenue over the note. So there's nice symmetries that start allowing you to connect accounts within a single transaction, even when you're talking about, all right, the financials for the borrower versus the financials for the lender. I want to look at non-interest bearing notes, or talk about non-interest bearing notes. And I put non-interest in quotes because it is kind of a misnomer, or it's a bit of a falsehood. Basically, when we say we have a non-interest bearing note, it typically bears some amount of interest. This is when we call it implicit interest. And let's look at a problem. To see how that works out. And it's a problem from it's a problem from the chapter 7, assignment 7. So let me share my screen. So this is this non-interest bearing note receivable. We got, again, this algorithmic, so not necessarily the numbers you had, but just the numbers that came up for me when I loaded it up. On June 30th, they sold merchandise to a customer and accepted a non-interest bearing note in exchange. The note requires a payment of $46,000 on March 31st. The fair value of the merchandise exchange was $41,860. They add this, that they view the financing of the note as significant, so that, I mean, it's kind of a way to communicate that you're going to have to accrue interest on it. But I want to look at, so just with these terms, we have 46,000 due March 31st of 22, exchanged merchandise with $41,860 of value. And it wants us to give the December, and that was on, sorry, June 30th, 21. All right. So once the accruals on December 31st and March 31st. So with this note, there's a couple of things going on that, you know, we want to be cognizant of. The first thing is we have a 9-month note because it's going from March to June. Sorry, from June to March. If it went from March to June, it would either be a 3 or a 15-month. But we got, so we're going all of July to the end of December, and that's 6 months. And then we got 3 more months. We got January, February, and then all of March of 22. So we got a 9-month note going on here. And the way that I make a journal entry for this note, when the interest is, or the interest, the financing part of it is considered prominent or material, is for the lender, is what they ask for. But I'm also going to sketch out the borrower. So the lender is providing merchandise, and I won't do the cost of goods sold because we just know that this was the sale price of the merchandise. It said its fair value was that. So that's the sale price. And in exchange for this sale price, they're saying, hey, pay me $46,000 9 months from now. So they got a note receivable for $46,000. And they sold merchandise for a sale price of that amount. So they actually only are able to record the sales revenue for $41,800 or $860. Now, that might not make sense because if you think it through, you're like, wait, but they're going to receive $46,000 of cash in the future. And that is where the interest comes into play. Because one of the definitions of interest, implicit interest, right, is any amount of money paid or received in excess of amount that was borrowed or lent. So, right, it reads both ways depending on whether you're the lender or the borrower. For the lender, it's any amount of money received, in excess of the amount that was lent. For the borrower, it's any amount of money paid in excess of the amount that was borrowed. So the lender is going to receive, in this case, $46,000 when that note matures. And they only lent lent kind of in quotations and in rabbit ears, because they didn't really lend it, but they gave them, I mean, effectively they lent it because they sold this person a merchandise that had a sales price of $41,860. And they're saying, hey, don't worry about it. Don't give me the cash today. Pay me later. So they effectively lent them $41,680, but they're going to receive $46,000 in the future. And so the amount of excess that $46,000 is over the sale price is the amount of interest, implicit interest, that is a part of this arrangement. So it comes out to $4,320. Because I lent this much but get back this much, that means I'm getting some interest. Even though it's not explicit stated, you have to pay me 2% interest every month or every 6 months or every year, that would be explicit interest. But the fact that they're paying me back more than they borrowed, that's implicit interest. And we record that implicit interest as a discount on the note receivable. I'll just shorthand it NR, 4,320. Now the borrower would receive, we'll just call it, inventory. We'll pretend that they bought inventory with this note for $41,680. And they have a note payable because they had to pay for $46,000, and they have the same thing, except now they're on the other side of this transaction. They're on the borrower side. So they have a discount on a note payable rather than a discount on a note receivable, because they owe money. They have to pay money in excess of the amount that they borrowed for $43.20. It's the same for both parties. So that is how the note is initiated, right? The note itself is recorded at its face value, the amount that's due. The goods or services that we exchange are recorded at their fair value, their sales price. And this guy, this discount, any discount is a contra account. Here we have a discount on a note receivable. That's a contra asset. Here we have a discount on a note payable. Because it's paired against a payable, it's a contra liability. So just like all other contras, they're going to reduce the amount that I provide on the balance sheet of this note receivable or note payable when it is put on a financial statement. So if it's a contra asset, that means the rules of debit and credit are reversed from assets. That's why we credit it here, because we're creating it. It's being created by our agreement to this contract. And for a note payable, it's a contra liability. So the rules are flipped from a liability, which means that debits increase it and credits decrease it. But perfect mirror images of each other in terms of what the borrower and the lender are doing at the outset of this note. So also to be emphasized is any amount of a discount on any financial transaction reflects the total implicit interest. For the borrower, that's total implicit interest expense. For the lender, that's total implicit interest revenue. So when we record, this problem throws in a slight wrench because it's a 9-month note. When we record this, there's two ways to really think of it. You could calculate the annual interest rate and then record it for the appropriate number of months, which is a little bit overkill. Or you can reflect on the fact that if this is the total implicit interest that I'm paying on this note over the course of 9 months, then I need to figure out, all right, I took this out on June 30th, right? This note was signed on June 30th. So how many months have passed from June 30th to 12/31/21, right? So I have 6 months have passed. And I have 9 months of interest that needs to be recognized over, I have $44,320 of interest that needs to be recognized over 9 months. So 44,320 represents 9 months. Then if I divide it by 9 months, I get a monthly amount. And then if I want 6 months of interest to be accrued, I could just multiply it by 6. So essentially what I'm looking for is 2/3 of the 4,320. And that comes out to $2,880. Interest accrued from 6/30 to 12/31. So when I record this, the way I know, well, there's a couple of ways I know this is total implicit interest, because I just defined it for you. I said any amount of money that's going to be received by the lender in excess of the amount that was lent, right? So I know by subtracting those two, this is the total excess, 4,320. I also know because when I make this journal entry at year end, when I go to record the adjustment for the interest amounts on the part of the lender, I'll record it like this. I'll debit the discount on the note receivable and credit interest revenue for that amount. And for the borrower, this is all at 12/31. I would record interest expense and a credit to the discount on the note payable for that amount of money. And so let's look at what's happening here to the discount real quickly. We can just look at one of them and you can do the other one. So if we just look at the note receivable, it started at 4,320 and it started at a credit amount. But then at the end of the year, we debited that amount. and reduced it. 4,320 minus 2,880 gives me 1,440 remaining. So we're reducing the amount of the discount as we record interest revenue. By the end of the deal, that next amount, it's going to reduce it even further, right? It's going to take it the rest of the way, because this now reflects the 1,440 reflects only 3 months of the total amount. And you can check that if you want. We had 4,320, that represented 9 months. And now we just want 3 months of it. Then 4,320 essentially divided by 3, because the 3 and the 9 reduce, gives me 1,440. So that represents the 3 months of interest remaining. So then on 331, we would have that next entry that would reduce the discount on the note receivable to 0 and record more interest revenue on the deal. That would reduce this account to 0. And then the next piece would just to be collect the note. We receive cash for 46,000. We credit the note receivable for 46,000. And the note is off the table because they paid us back. And now it makes a little more sense. When I originally said, oh, you might be a little confused. Why are we only recording sales revenue of 41,860 on a note that promises I'm going to be paid $46,000 of cash? And the answer is, my sales only constituted a portion of this arrangement. The actual items, the inventory I sold, were only $41,860. Well, that's my sales revenue. The rest of the revenue that I'm recorded is not coming from additional sales. It's coming from the fact that I lent that sales revenue. I lent the money they should have paid me at that date. And now I'm recording it as interest that's being earned through a financing arrangement over time. And it also shows me that every dollar of note receivable that's in the discount on note receivable, every dollar as it's being reduced is recorded as interest, either interest revenue for the lender or interest expense for the borrower. And that is being amortized over time. We actually call this process, so the process of reducing discounts or premiums on financing, on financial instruments. It's called amortization, which I know also is a crossover for what we call reducing or the cost allocation applied to intangibles. But amortization is just Greek. It's from a Greek root. Amortize means to kill off. And so we're just killing off this amount of money over time, reducing it, and recording interest revenue at the same time over the deal. Don't ever think that discounts or premiums relate to some sort of profitable outlook. It's just telling me that there's some implicit interest that has to be recognized, either added to or reduced from the amount of interest I would otherwise record. Okay. But this is basically how you work through a note receivable problem. or at least the, the extent to which you need to know.